Hi, I'm Jeffrey Roach, Chief Economist for LPL Financial, with three talking points for the current macro landscape. First, Hormuz is most important for Asia, not the US. So roughly 20% of the world's oil goes through the Strait of Hormuz. However, 90% of that goes to Japan, China, India, and other Asian countries. The numbers on the map signify the flow of barrels per day at various maritime choke points. Now, about 24% of total daily production never boards a ship. But since so much of Asian markets rely on tankers getting through the Strait of Hormuz, we shouldn't be surprised that Japan's equity market was seriously impacted by the current conflict. Our view is the longer the strait is blocked, except for mostly Iranian tankers, the more Iran gains as a net exporter and other Middle East producers lose revenue, and further, the fragilities of Japanese markets in particular remain in effect. Second, data center construction outpaces office. We're in the early innings of AI utilization rates, especially for healthcare, hotels, and restaurants. So we have a lot more to go on the demand side. Now shifting to the supply side, AI-related construction activity is an interesting stat worth monitoring. We recently hit a record in spending on data center construction. Last quarter, businesses spent more on data center construction than general office construction, and the monthly run rate remains higher than office construction. This will have an impact on electricity demand for the foreseeable future. Third, consumers have ability to service that debt. When I'm asked about recession risks, I look at this debt service ratio to give me some of the metrics I need to assess the health of the economy. For now, consumers have fairly low debt servicing pressure, and this ratio that I'm showing here is household debt service payments as a percentage of disposable personal income. And what we see here is mortgage servicing costs are just about approaching pre-COVID levels, whereas consumer debt servicing is the lowest since those years of deleveraging in 2011 and 2012. Well, that's all for now. If you want more insights on global market trends, follow us on social media and take care.